will weaken. I mean, if you are speculating that it will weaken, why would you hold more of it? If, for example, I'm speculating, I as the Commercial Bank of Kenya, I'm speculating that the USD will weaken. It will come back to 120. It's now 125. I think 130 or so. Yeah? It will come back to 120 over the next, let's say, 30 days. Why would I buy more of USD? Exactly. I will sell more. If I have any USD, I will sell the much I have at now the current, now the price that is we are at is now the higher price, because we are expecting or speculating, and that's where forex risk comes in, that the USD will weaken, which is very rare, will weaken against the Kenya shilling. So if I have, let's say, 10,000 USD, I'll sell them, and then should it weaken, should the USD weaken, then I will have not made losses. I will have, in fact, in nominal terms, I will have made some profit, right?
Yeah.
Exactly. As opposed to holding more of it, which should it weaken, then you'll have ended up getting into a whole lot of loss. For example, another example, if let's say KCB Bank has $100 million in USD, and you also have, let's say, $180 million in another currency, no, in the same currency, but the difference in loans, because the asset liability mix. This is what I'm trying to say. Let's say, as KCB Bank, you hold 100 million in loans. Let's say you have given 100 million USD backed loans or facilities, but also your customers have given you 80, let's say 80 million USD, that part of which you have used to fund the 100 million loans that you have given out. So your open position will be the difference between the long position that you hold, the 100 million, because that's where you are holding more in anticipation that the USD will rise. When it rises, customers will pay more USD than they, and then so you will have gain. So the open position in this case is now the difference between the long position that you hold, the more currency that you hold in anticipation that it will rise, and the difference between the short position that you hold in the 80 million deposit that you hold. So now that comes to 100 million minus 80, that comes to 20 million USD. So now that's the open position that you hold, which is in itself a risk, because you never know. It can end up that the USD, the 80 million that USD, the strengthening, and the one you are expecting to strengthen has weakened, and then you end up making a loss. So that difference is now the risk, and that risk is called open position. Okay? So now that's how we can calculate now for example, the forex risk between those two